Welcome back to Sunrise. Good morning if you're just joining us. So this morning, Carlton continues our lesson on how to build a strong financial portfolio, focusing on fixed deposits and mutual funds. We'll learn some strategies for optimizing our investments and navigating the complexities of these two popular options. So over to you, Carlton.
Good morning, people. How are you both doing?
We are good. We are good.
Denise, you win this morning. You win this morning.
By default.
Congrats.
By default.
But here we are this morning as a winner, and we can all win this morning when we understand our portfolio management. So over the last few weeks, we have been looking at building a strong portfolio. Yeah, and persons hear about investing sometimes it's daunting if we don't understand stocks, even though we may break it down in the Money Master class. You don't understand bonds. And it's perfectly fine because you have other things that you can do. And we look at a mutual fund first. So if you want some amount of diversification in different areas, for example, stocks or bonds, and you don't understand, or you don't have the time to watch the stock market on your own or to understand and break down like the bonds, etc., a mutual fund is right for you. So what is this really and truly? It's a managed pool of money. So we get money from Yendi, we get money from Dennis, from Carlton, from the Cup Soup Boss, from everybody. We put that money together, and then this pool of money is managed by a fund manager. So they'll take this pool of money and say, let me go and invest it in stocks for you and or bonds, or maybe in real estate. So you, the common investor, does not have to go out to do the hard work of watching the stock market, watching here and there. In Jamaica, you may hear the term unit trust, which is a type of mutual funds. So once you understand the concept of a mutual fund, which was the pooled money, similarly here in Jamaica, you hear the term unit trust. But what is this for you? The benefit of this for you is diversification. So instead, for example, of you putting your $1 million in one stock or $100,000 in one stock, for example, if you go into a mutual fund / unit trust that is heavily leaned towards, say, for example, equities, which is within shares, then this mutual fund is already stretched across several different companies. So you're not at risk in just only in one company. So for example, if that one company goes down, their stock price goes down, you may lose your money. In a unit trust, for example, because there's so many different companies, chances are it's much better for you. If one goes down, one may be steady. It is highly unlikely that all companies will go down at the same time. So that helps you with diversification. It's managed by a professional. So these persons know what they're doing. They have the time to sit down for you and do all the hard work. They're watching the market for you. They're watching what company is doing very well, what time of the year is best for what company. So you don't have to worry about that. And then, for example, thirdly, it's easier and cheaper to get access to all of this. So, for example, when you're buying stock, you're trading, you're paying to trade in this company, for example, but fee for this company for all the trading. One money up front, and you have access to all of these companies. That's the major benefit of the mutual fund and or unit trust here in Jamaica.
What's the downside? The returns are smaller, what?
The return on general is smaller compared to on the stock side, meaning if you're going directly into that only, because the risk of all of that happening is generally a major challenge for you.
So as you become older and less and you're more risk averse, you might switch your investments into mutual funds?
Yeah, exactly. And or you can say to yourself, I want a unit trust, which is heavily in bonds, because you know bonds are much risky, less risky. Or you want to say, I want something more, a nice mixture. So here in Jamaica, when you open, they will tell you that this fund invests in equities, for example. It invests in bonds, invests in real estate. So you as the investor can make a decision, this one is right for me because I want to go in real estate, for example.
So some brokerage houses, or some money managers are more averse are better at one thing than other, or they're more known for, or it is particular trust?
Yes, a particular trust. So each trust, they will tell you what they're exposed to. So I'm more exposed to X, Y, and Z. So generally, everybody who handles a trust will have a good idea of what they're doing. It's just the asset that they're investing in at that particular time.
Got you.
Jump over to fixed deposits. So you'll hear the term fixed deposits, FD, or CDs, which are called certificate of deposits, or TD, they're called term deposits. This is really you taking a lump sum of your money and you give to the investor, to the bank, to the person that is offering this, to the company, with a fixed amount, the $1 million, for example, at a fixed term, 30 days, 60 days for a fixed rate. So when you're giving your money into the company, you have a good idea that I'm giving them for 1 month, for 3 months, for 6 months, thereabout. And when I give you that money, I will get 8% for that period. And for or a fixed term, which is what you're mentioning. The pros of this, it is low risk. The lowest risk that you can find, because at the end of the day, you're getting back your money that you're giving the company. And the rate is fixed, so you know what you are getting. You know your return upfront already. Unlike stocks, for example, you don't know what will happen in the market. Drop down to the cons, because it's low risk, the rates are generally much lower than those in the equity space, for example. And there's a penalty if it is that you close early.
Right.
So if you say you want to keep it for 6 months, but something comes up, you want back your money, the interest that you were supposed to get for the 6 months period, you will no longer get that. You'll get the prorated amount, which is not bad either. And then the interest is taxable. So there's a withholding tax that is applied on the...
viewed as income.
That's viewed, yeah. All right? But how do we quickly calculate so you can understand? So to calculate the interest on your fixed deposit, it's the amount multiplied by the rate, divided by 365, the number of days in the year, multiplied by 30, for example, because that's the minimum amount of period that you can have a fixed deposit for, which is for a month. It is prorated because you can ask for your money at any given time. So the rate goes down to per day, just in case you keep it for 32 days. 35 days, for example, instead of 60 days. So say you have $1 million, you put the $1 million multiplied by the interest rate, annual interest rate of 6%. Right now, rates are good in the market for fixed deposits, above inflation rate right now, which is perfectly fine. So you get $60,000 divided by 365, that is $164 per day, multiplied by 30. So if you have $1 million, for example, your interest will be about $4,931 before tax, about $5,000, which is not bad, because if $1 million goes into your regular savings account, they'll land nothing at this point in time. So these are two options that you can look at, generally low risk options that you can look at to give you some diversification and give you a nice ease and peace of mind and let your money work for you. If you want more information on this, you know where to find me, and I'll be happy to send you on over to somebody who can assist you with some of these investment products.
All right. All right. Sounds good.
On the other side of the break, it's time for Diaspora Link Up with a Jamaican soul in French soil. Stick and stay. More Sunrise is up next.